Now we're going to derive the demand for reserves. You can think of the quantity demanded for excess reserves as how much big withdrawal insurance banks want to purchase at the federal funds rate. And you think of the federal funds rate as the cost because the cost of excess reserves is the opportunity cost of not making loans to other banks. They could have made loans, instead of holding on to reserves, they could have made loans to other banks. Banks needing reserves to meet the reserve requirement. Yep. So generally speaking, if the federal funds rate falls, the cost of excess reserves falls. Those banks are more willing to purchase more big withdrawal insurance. So there's a negative relationship between these two. The demand for excess reserves is a negative relationship, and we're going to define this parameter S as a shock parameter. The price of the insurance is over here, the quantity that is purchased is over here, and this is a shock parameter. And that shock parameter increases if there's a government intervention like wage and price controls, in economic growth. If the economy is growing robustly, default risk is lower, and consumer and industrial loans rise. Or if the reserve requirement ratio is adjusted up or down. And that's because when the Fed messes with the reserve requirements, it creates uncertainty in the banking system. And then, of course, bank panics. Okay, so all those things are going to increase the shock parameter. Now, the quantity of required reserves is demand deposits times the required reserves ratio. So it's just very simple. Required reserves ratio times demand deposits. Okay. Now, for the quantity demanded for reserves, there's two components. There's this amount of required reserves plus this function of the price of big withdrawal insurance, right? So this is a function of the federal funds rate. I'm going to replace this with what it equals. I'm going to replace this with what it equals. So the required reserves equals the required reserves ratio times demand deposits. This equals that shock parameter minus the federal funds rate. And then I'm going to rearrange with noting that the coefficient here is 1. And then I'm just going to say, well, so I just move this over to here and I move this over there, right? So I add this to both sides and I subtract that from both sides. And that's generically, instead of assuming that it's 1, we'll just assume it's A. And I call that the aversion to holding excess reserves. Okay? So this right here is the demand for reserves model. Okay, so let's try out an example. If the reserve required ratio is 10%, demand deposits are $50 billion, shock parameter is 25, and our slope is 1, let's graph our equation. Well, the slope is 1, so 1 times QDR is just QDR. I plug in the 0.1 for reserve required ratio and 50 for demand deposits, and then the 25 shock parameter. So required reserves are 5. Required reserves plus the shock parameter is 30. Okay, so this is our demand for a very simple demand curve for reserves. So if the federal funds rate is 2%, if this is 2, what does this have to be? Well, it has to be 28, right? So we plot that point. And then if quantity demanded for excess reserves is 25, that means the federal funds rate is 5. We connect the dots and we have the demand for reserves. Okay, so that's demand for reserves. The supply of reserves has a vertical part, which is the sum of borrowed reserves and non-borrowed reserves. So, and non-borrowed reserves is normally 0, or non-borrowed reserves is huge, and borrowed reserves is usually 0. Okay, and that's because if the discount rate is bigger than the federal funds rate, then what's going to happen is banks are going to want to borrow from other banks at the lower rate. They're not going to want to borrow from the Fed. So they're not going to go to the discount window and borrow from the Fed. And this is normally what's the case, right? If the opposite is true, which was historically accurate up until 2003, if the federal funds rate is greater than the discount rate, then banks will want to borrow from the Fed, right? But from here on, the federal funds rate is usually set below the discount rate. So this is the normal situation now. This was what it was before. Okay, so the vertical section in this example is just borrowed reserves plus non-borrowed reserves, 28. And the horizontal part is the discount rate, which is 3. So to make the supply of reserves, you go up and turn right, okay, at the discount rate. Okay, so now let's put them together in the market equilibrium. I'm just going to go to the example here. So we have our demand curve, which we derived from these parameters up here previously, right? We plot the points, right? Then we have our vertical part of our supply curve, which is at 28 billion. We have the horizontal part of our supply curve, which is at a discount rate of 3. Go up and turn right. The equilibrium is just the intersection of the two. So the equilibrium quantity is 28. If I plug 28 into the demand curve, I get 2. So the equilibrium quantity is 28, and the equilibrium interest rate is 2 percentage points. Now suppose the Fed increases the discount rate to 4 percentage points, or 4%. So the new height of the supply curve is at 4. So the supply curve essentially shifts upward. Has no effect on the equilibrium. Okay. Now the Fed, starting in 2003, started setting the discount rate 100 basis points above the target. So this is not going to be the case. So if the Fed wanted to raise the discount rate up to 4, it would raise the federal funds rate up to 3. Okay. Okay, let's try a different example. Instead, suppose the Fed increases the required reserves ratio to 14%. So it was at 10, now it's at 14, right? Remember from what we said earlier, when the Fed changes the required reserves ratio, it tends to cause a shock. And so the shock parameter increases, for example, here to 26. So we have a new demand curve, right? And our new demand curve, if the Fed allows interest rates to rise above 3, if I plug 28 into this new demand curve, I get 5. So the demand curve will shift out at this point, and it's parallel because we're assuming the slope doesn't change, right? So the demand curve shifts out to this point, right? But the discount rate, as it is now, is a binding price ceiling. So the Fed is not going to allow interest rates in the banking system to go up to 5% in this market, this federal funds market. So what it does is it does discount loans. The amount of the discount loan has to do to keep interest rates from going above 3 is the difference between this value and that value. And this value here is 30. So if I plug 30 into my new demand curve, if I plug 30 in here, I get 30, or I get 3, right? 33 minus 3 is 3. So the Fed's going to do discount loans of about $2 billion to keep the federal funds market at 3. Okay. Now this isn't very wise when the Fed changes the reserve requirements, because what it does is it leads to a big collapse in bank lending. If it leads to a big collapse in bank lending, there's a drop in the money supply, right? And the Fed has to do discount loans to banks. It basically manufactures a banking crisis. So the effect on this is to reduce the money supply. So money supply reduces, and then the interest rate that consumers, prime consumers, and prime businesses prime borrowers have to pay goes up. So this increases the real rate of interest if inflation expectations remain unchanged. So a higher real rate of interest decreases investment and exports, and oftentimes will push us into a recessionary gap. So we were doing just fine. We were in an inflationary gap. The Fed changes reserve requirements and pushes us into a recessionary gap. So the Fed rarely does this, right? Okay, what about an open market purchase? Cash flows from the Fed to banks because the Fed is buying bonds from banks, treasuries. So the quantity of reserves in the federal system, federal funds market, increases. The federal funds rate, interest rate, decreases. And this is called expansionary monetary policy. Open market sale is just the opposite. The Fed has bonds to sell because it has purchased them directly from banks or from Treasury or from other banks in a previous open market purchase. Banks give cash reserves to the Fed in exchange for Treasury bonds. The quantity of reserves in the federal funds market declines, and the federal funds rate increases. And this is called restrictive monetary policy. So let's go through an example here. So the Fed is doing an open market purchase. It's increasing non-borrowed reserves from 28.5, right, by buying bonds from banks. Banks get cash, Fed gets bonds. So there's no change in the horizontal section, but the vertical section shifts the supply curve to the right. And the new equilibrium with our original, that demand curve that we derived, our new equilibrium is 1.5. So this is how the Fed pushes down interest rates from 2 to 1.5. Okay? Starting in 2003, the Fed began setting the discount rate 100 basis points above its federal funds rate target. So when it lowers the federal funds rate to 1.5, it has to lower the discount rate to 2.5. So the supply curve ends up moving to the right, and then it moves down. Okay? Now, the increase in unborrowed reserves means banks have more cash to lend to consumers and businesses. So if the multiplier is 4, right, we multiply the 4 by the change in reserves, and that was 0.5 billion. So the money supply will increase by 2 billion. And that lowers interest rates from 3.85 to 2.75. Okay, so if inflation remains unchanged, the real rate of interest falls too, which increases investment expenditures and exports. And that, so by design, what the Fed's trying to do is the Fed's trying to push aggregate demand up to this point to go from low GDP to GDP that's just right, GDP that's equal to potential, right? Also, unemployment is really, really high here. Unemployment is just right, equal to the natural rate of unemployment there. Okay? So we do get higher prices, but the purpose of this policy is to get rid of high unemployment that is persistently high. What about an open market sale? Say instead the Fed sells 0.5 billion bonds worth of bonds to banks. There's no change in the horizontal section. The vertical section drops to 27.5, so the curve moves to the left. The new equilibrium, if we plug that into our original demand curve, we get 2.5%. So our new equilibrium is 2.5%. Now remember the Fed's policy. It's got to set the discount rate 100 basis points above the target. So it's going to shift the supply curve up. So what the Fed does is it shifts supply to the left and then pushes supply upward. Okay? Now, lower non-borrowed reserves means banks have less cash to lend to consumers and businesses. The money supply decreases via decreased lending. If the money multiplier is 4 and the decrease in reserves was 0.5 billion, the money supply will drop by 2 billion to 498, and that pushes interest rates up to 3.75. So if inflation remains unchanged, the real rate of interest rises with the nominal rate of interest, and investment and exports will fall. And the purpose of this is to get us out of an inflationary gap. So here, unemployment is too low. It's lower than the natural rate of unemployment. GDP is higher than potential. And without this intervention, the theory suggests that short and aggregate supply will shift up here, which causes even more inflation. So the Fed's trying to prevent that inflation by pushing aggregate demand down. This results in lower GDP, but GDP equal to potential, higher unemployment, but unemployment equal to the natural rate, and then it keeps prices in check. Now we're going to look at how the new policy the Fed got in October of 2008 helped them combat the 2008-2009 financial crisis. Okay, so right now the market is in normal mode. The federal funds rate is positive, 100 basis points below the discount rate. The equilibrium is right here. Supply of reserves is kinked at demand or at the discount rate. Now the Fed had to do a massive purchase of mortgage-backed securities, and so I suspect that when it analyzed this with theory, that massive purchase of mortgage-backed securities would have pushed the federal funds rate into negative territory. So what the Fed did with interest on reserves is it kinked the demand curve at interest on reserves. And the reason why that is because if you're a bank, would you rather lend your reserves to a bank at a negative federal funds rate, or would you rather lend your money, your excess reserves, to the Fed at a positive interest rate? And so that's why interest on reserves kinks the demand curve. And the new equilibrium becomes this point right here. Okay. The interesting thing about this is the Fed can buy now as many reserves as it wants from banks, or purchase as many bonds from banks as it wants without affecting the interest rate. But what this does is it increases the number of excess reserves, because what this interest on reserves is, the discount rate is a non-binding price ceiling on reserves, whereas interest on reserves is a binding price floor on reserves. So as it buys more of these securities from banks, it creates more and more excess reserves. So it can buy or sell securities in crisis mode without affecting the interest rate that banks charge each other for for reserves that they need to meet the reserve requirement. Okay. Now, the Fed, if it wants to raise interest rates, what it can do is it can just raise the floor, interest on reserves. It can raise the floor. When it raises the floor, it increases the value of the equilibrium interest rate, the federal funds rate. At the same time, because of its 2003 policy, it also raises the discount rate. So it can raise or lower interest rates without changing the quantity of reserves. And these are just dictates, right? Now, when it raises interest on reserves, just like raising a binding minimum wage, you get more unemployed people, unemployed workers. When the Fed raises interest on reserves, it's going to increase the quantity of excess reserves. So excess reserves are here, the difference between my cursor and the red line. So after the increase, it's here. Before the increase, excess reserves were this difference, the cursor and the red line. So the kink, right? So it increases unemployed reserves or excess reserves. So to get back to normal mode, the Fed will probably combine some open market sales with raising the interest on reserves. And as the economy expands, the demand curve for reserves should increase too. So that'll help. So the demand curve is shifting, right? The demand curve went from a low level here, right, out to a higher level. So the Fed's going to let demand rise for reserves as the economy grows. It's going to sell some securities and then probably combine that with higher interest rates. And then the Fed is back in normal mode.